Starting. All attendees are in listen-only mode.
Good evening, everyone. Thanks for joining us for our webinar on managing staff salaries. This is Nathan Hayes with Prima. I have Dr. Steve Vargo on with me as well. Say good evening, Steve.
Good evening, Steve.
Very excited to.
That was a softball. Good evening, everyone. Thanks for joining us.
Very excited to share what we have with you tonight. We've got prompting this webinar two things. First would be that we've finished our 2016 staff salary survey and want to share those results with you. And also, there have been changes to the FLSA overtime rules, and so we want to review that with you, particularly for those of you who have salaried your managers, for instance, or have employees on salary that might be pushing against the limits. Want to review that with you so you don't come against the rules in your practices. But let me. I'm going to start us off and really start with asking, how do we evaluate our staffing levels in our practices? So, two questions when it comes to our staff, and this is germane to the staff salary survey, is how many non-RD staff should you have in your practice, and how much should you spend on your non-RD staff overall? And there's really three questions that I think are at play here. One is, what is your revenue per non-RD staff? Most practices will have one non-RD staff per 150,000 in revenue. So in other words, if you take your collected gross revenue and divide into it the number of full-time staff you have, normally it's going to come in between 125,000 and 175,000 per non-RD staff. So that's one piece. Do you have an appropriate headcount? And we're using this revenue per non-RD staff as a proxy for estimating really how many patients you have coming through the practice. So if you're a higher revenue per patient practice, you might be able to make do with less staff. Your revenue per non-RD staff may just run higher, and that's okay. In more expensive labor markets, also, I mean, the third thing, so one, how many staff should you have? Two, what's the overall percentage of your gross that you're spending on staff? So most practices will spend between 18 and 24% of revenues on staff. That's not always the case, and we'll talk in a minute about the different cases where it varies. But the third piece is going to be, what's your average pay per employee? So if you look at the staff salary survey data for this year, most practices average about $16 an hour per employee, or $32,000 per year per employee before you start adding in payroll taxes and benefits. And anecdotally, from my looking at many of your profit and loss statements, looking at your benchmarks with you, practices will spend between, say, $27,000, $28,000 per employee in much less expensive labor markets. So in the Southeast and in rural areas, up to about $34,000, $35,000 per employee. There are definitely practices that are spending closer to $40,000 per employee on average. And in those cases, you almost have to make do with less staff. Hopefully they're very productive, because you're going to end up eating up your entire budget with people. It is a double whammy if you're overstaffed and in an expensive labor market in terms of hitting up against your budget and your profitability. Now, remember also that when we're looking at staff as an overall expense, we don't want to look at them in a vacuum. I always want to put cost of goods and staff together, and the key benchmark would be keep that under 50% of revenues. Most practices are going to be between 45 and 50% of revenues, but that can vary a lot. So traditionally, it would be something like 30% of revenues go to your materials cost, your labs, your frames, your contact lens bills, plus or minus 3%, 20% to the staff, non-RD staff, plus or minus 3%. But we're seeing now that in more medically oriented practices, the cost of goods might be in the low 20s, 20, 21, 22% of revenues, and the staff investment has a corresponding increase. It pushes up to 25 to 28% of revenues. In a Medicaid practice, your cost of goods might be as low as 10 or 12% of revenues, or 15% of revenues. And staff investment might push up over 30% of revenues. In that case, there's not as much of your revenue tied to the cost of the glasses you're selling to your patients or contact lenses, but to do the patient volume necessary, it takes a big staff. So we see an increase in staff. Again, don't take staff in a vacuum. If you're spending more on staff, check your cost of goods. Chances are it's lower. And if not, then we can certainly look at your budgets together with me and evaluate what's off. Maybe the cost of goods is high. Maybe you're overstaffed. Maybe your staff are paid well above average, and we need to reassess how we're structuring compensation or our staffing levels. if you look at the numbers, and I want to say this too about staff, it's I never want to be too mechanical about the benchmarks. What we're going to share with you in terms of the staff salary survey data, what we share with you in terms of benchmarking your practice is really just giving you a reference point for what do the majority of optometry practices look like. And if you look different from other practices, it may be that you're doing better. You might just be in a low labor cost area, and you can keep staff costs low while maintaining an appropriate staff. You might be doing worse. You might just have had salary creep over time in your practice and your wages have pushed higher than they ought to be. Or it may just be something structural. I mean, if you're Dr. Vargo and I were up in New York this weekend talking to some ODs and discussing some of our previous salary data, and someone just said, hey, that's a joke what you've got there for the average wage for optician. In New York, I couldn't dream of paying that and getting someone good. And they're right. So there can be areas like a major city like New York City where labor costs are just higher for certain roles. And that's a structural thing we just have to plan around. And again, maybe we make do with less staff, or maybe we really focus on the productivity side of staff. So not to get too caught up in it. But if you look at the numbers and you feel like, hey, my staff, I'm spending 15% of revenues and I feel like I'm understaffed by Nathan's numbers, I'm understaffed. I do want to say that when we're adding people to the practice and making that investment of on average $30,000 per person, the wrong way to think about it, anecdotally, would be I heard a speaker once say, hey, in my practice, the staff felt like we were understaffed, and so they told me, hey, we want to hire someone else. We feel like we're too busy. And this doctor told his staff, well, that's fine if you can, we know the average staff will generate $115,000, per staff member. So if you guys can generate another $150,000 in revenue, we'll hire someone new. And so the staff put their heads together, put their heads down, and went out and generated another $150,000 in revenue. And he hired a new staff member. To which I say, well, you got it backwards, because the staff just proved they didn't need another person to generate $150,000 in revenue. When we're adding staff, it needs to be with the idea that we are unable to either deliver the service we want to deliver, but ideally, it's with the idea that by adding a new staff member, we're going to grow the revenues of the practice. Probably by $150,000 in revenue, or $125,000 in revenue. How are we going to do that? It either needs to be with the idea that we have a patient backlog, we just can't see everybody. If we had one more staff to help with the patient flow, then we could start generating more revenue. Or we're losing patients in the optical, or we just can't deliver the level of service we want. We think if we added a staff, we can have a higher capture rate in optical. People will feel better taken care of so that we can justify our fees and our markups. So it needs to be with the idea that adding a new member to your team is going to either, well, probably both, increase the patient volume you're able to see and that there's patient demand there to be met, and also raise the revenue per patient or revenue per exam. Keep that in mind that you're investing back into your practice, so there needs to be a return on that investment. Now, to the actual results from this year. Here are the results from the 2016 staff salary survey. These will be put into a format that we can email out to y'all, so as Prima members, you have access to this data. We will absolutely share it. The way we structure this data, I just want to talk through, without getting into the specifics of what the results were, how to use this in your practice, and then that'll flow to some questions on salaried employees. But what I've done is I've set up a report where we'll have for each role in the office, we'll have the low results, so the lowest numbers someone reported paying their bookkeeper, for instance, the 20th percentile, the median, the 80th percentile, and then the highest results shown. And for most practices, this range of the 20th percentile, median, and 80th percentile will pretty much describe where you'll be. It's the middle 60% of practices. It's a very good reference point for the majority of practices. If you are, my new friend from New York City who was laughing at the idea of paying $18 or $20 an hour to an optician, you may decide that, hey, I need to be in this 80th to the high range. For a licensed optician, maybe I'm spending $25 to $40 an hour, $50,000 to $80,000 a year on an optician. And for the state of New York and New York City, that's not uncommon. For office managers, those practices spending $60 an hour on their office manager, which annualizes at about $120,000, I can basically guarantee you are $4 million plus in revenue, probably multi-office. So some of you may if you feel like you're in that range, we can certainly talk about it. Most will fall in this range. And I talk about office managers in particular here to say that for many practices, there's a temptation, with good reason, to say that my manager, that they have responsibility over other staff, and I think I want to make them exempt. And so there are new rules around exempt employees, which means that they're salaried, not paid hourly. And I'm going to let Dr. Vargo take over and talk on that subject. And just review the new rules with you. And we'll take questions at the end, so feel free to use the question tab as questions arise.
Okay, thank you, Nathan. So the new overtime rule. In a nutshell, the rule basically resets the salary threshold. It's a new salary threshold that was basically increased to the point where that it was pushed forward to make your exempt from overtime pay. The threshold is increased. Sorry, that's what I was trying to get out. The definition of the overtime rule, it's part of the Fair Labor Standards Act. And you may also hear it referred to as the white collar or EAP exemption. So it tends to be more of it would apply to more white collar workers. EAP stands for executive, administrative, or professional. So employees covered by the FLSA obviously are required. You're required to pay them overtime at time and a half when they exceed 40 hours of work in a given week. You'd pay them at a rate not less than 1.5 their regular rate of pay. And it's important to note as well that this is calculated weekly. Even if you pay them biweekly, you couldn't, for example, pay somebody, or rather, let's say they work 38 hours one week and 42 the next week. You can't average that out to 40. You would still be obligated to pay them overtime for the week that they worked 42 hours. And this new rule will become effective December 1st of this year. So what determines if an employee qualifies? And when I say qualify, I'm referring to qualifying for exemption from overtime. You must be salaried. And there are some criteria you need to meet for to make put somebody on salary versus hourly. Their primary duties must be performing office or non-manual work that directly relates to the management. Operations of the business or practice, and their primary duty also includes exercising discretion and judgment with respect to matters of significance. So basically in an optometric practice, this is typically a manager, someone with managerial duties, office manager, maybe optical manager. And they also must be paid more than $913 a week, and this is the new threshold, which is the equivalent of $47,476 annually for a full-year worker. So basically, they would need to be paid at this level or more to be exempt from having to pay them overtime. And again, these are people that primarily perform executive, administrative, or professional duties. This new rule does cover all employers. So you might be familiar with the like the FMLA, Family Medical Leave Act, where you have to have more than 50 employees. That's not the case with this. It covers all employers. There's no minimum number of employees for the new rule, and it's also some employees are not subject to the rule, and obviously relevant to us is doctors. So most doctors would exceed 47,476 annually anyway, but just FYI, your employed ODs are actually exempt from the new overtime rule. And so why the revision? Well, for one thing, it's a bit outdated. The last update was in 2004, and the The threshold currently is about half of what the new threshold would be. Currently, the threshold is only $23,660. So it was actually quite an increase from the old threshold, but again, keeping in mind that it hasn't been updated since 2004. And one of the driving factors here was workers' rights groups have argued for some time now that while companies have profited greatly since the overtime laws were last changed in 2004, that much of the growth has come at the workers' expense. And some of these groups have argued that the most vulnerable groups are those most likely to be exploited, that they tend to come from, most likely come from the lower income earning groups. And expect this to rise over the years. There won't be as long of a period without an increase. In fact, the Department of Labor will be increasing the salary threshold every 3 years. So the first update will be in January 1st of